Yo, 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 yo. It's your boy, the insurance junkie, your fiduciary fella, the all-star advisor Alonzo Hall. And I've returned today with another episode of Socioeconomic Saturday. So as you'll see, today we're talking about the breakup. And what does that breakup have a lot to do with? Well, That breakup has to do with the big four. So those are the big four accounting firms across the U.S. But before I go in, ladies and gentlemen, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, to contribute to channel growth or to schedule an appointment with a licensed financial professional, the links are in the description of this video. So, as I said in the title, it's about the breakup. So, what do I mean about the breakup? Well, thank you, brother, for the share. So, what do I mean about the breakup? Well, recently, some things have been happening with, again, one of the big four accounting firms and some moving and shaking that's occurred that may have an effect on maybe not you directly personally, but definitely you personally through the fact that these large corporations or these large accounting firms are definitely dealing with your job, your pension fund, etc. So let's take a look at the article here from the Wall Street Journal today. Let me set this up right. Bam! There we go. So this is an article from the Wall Street Journal, and it says Ernst & Young breakup plan stalled on partners split. A fight erupts between the U.S. and overseas leaders over the division of lucrative tax business. Bear with me 1 second there, guys. I got a text message here. Wow. Okay. That's awesome. What's I about to pull up here? It's another document I wanted to pull up. Give me 1 second. I gotta find my doggone text message now. Oh, did I close it? I may have closed it. Or not closed it, but deleted it. You know how that goes. Boom. FEGLI. Okay, well, I'll get to that momentarily. At any rate, let me just check the comments here. All right. So, Ernst & Young's breakup plan is in jeopardy, and the accounting firm's leaders are trying to salvage the deal by placating restive U.S. partners without pushing its overseas executives too far, people familiar with the matter said. The Big Four accounting firm has suffered a series of delays in its plan to split its global auditing and consulting businesses. Now, top executives are considering several backup options, including selling off just the non-U.S. consulting operation, likely to a private equity buyer, the people said. So Ernst & Young here looks like they're ready to split from international. So they no longer, I guess, want to have their U.S. Business commingled with their international business. They want to make a large global change. And some people on the inside are like, screw it, I'm just going to sell my portion, which is crazy, right? So the contingency plan puts pressure on the U.S. partners at the 390,000 person firm. They're demanding that the future audit-focused firm get a bigger piece of the firm's lucrative tax business. Ernst & Young's U.S. leaders Tuesday responded with a new plan for the split, which would move more of the tax practice to the audit side. One of the people familiar with the matter said, "That proposal is now under negotiation with the rest of the firm," the person added. So the reason that this is important is because you got to realize when people are splitting up and these firms are doing M&Es or mergers, M&As, mergers and acquisitions, etc., or they're selling off and splitting stocks and shares, etc., you're also now going to work for another company. I'll give you an example. When my mother-in-law used to work at Morgan Stanley, she had a colleague who left Morgan Stanley and then went to work at E-Trade. Then a couple years later, because she went to E-Trade for a higher salary. Then a couple years later, E-Trade was absorbed or purchased by Morgan Stanley. So now she left the company because she didn't like, a bunch of things plus the salary. She went to another company, got a higher salary and other perks and, work-life balance, et cetera, that she liked. And now, because of mergers and acquisitions, this financial firm is buying another one. But now people are like, well, hey, I don't want to work for that company. I don't like their, they like to sniff cocaine in the bathroom or whatever it is that I don't like about that particular company. So you want to be cognizant of that when you're looking at these things. And that's why something like this is important. So the horse trading is a result partly of EY's convoluted ownership structure. EY's global network is made up of separate country partnerships, each of which has its own rules for approving the sale of the consulting business it owns. Executing the deal requires approval from partners in each of the 75 countries due to take part, all of which operate under different legal, regulatory, and tax systems. EY's leaders in the fall gave the green light to split, dubbed Project Everest. But hammering out the terms of the deal is proving harder than the leadership expected. The plan had already been delayed last year by disputes, including over how to pay unfunded pension obligations to retired U.S. partners. Rising interest rates and fears of a slowing economy further complicated the deal. Votes on the split, originally due to start last year, are rescheduled for next month. That timing is now up in the air. The latest and potentially most serious roadblock is centered on the firm's $11 billion in revenue tax practice and stems from regulatory differences and a fight for the spoils of the breakup. Some U.S. audit leaders want the new audit-focused partnership to have a much greater share of the tax practice than the one-third envisaged in the proposal, according to people familiar with the matter. Excuse me. U.S. rules allow auditors to sell tax advice to their clients, giving a significant boost to revenues. Google parent Alphabet Inc., for example, paid EY more than $1 million in tax fees in 2021, on top of $24 million in audit fees, filings show. Elsewhere in the world, notably Europe, regulations generally bar auditors from selling tax advice. That means there isn't the same business rationale for an audit firm to retain a lot of tax advisors as there is for U.S. clients. The split is also about money. Under the plan, the consulting business would raise $11.5 billion in an initial public offering and borrow $18.5 billion. That $30 billion would fund multi-million-dollar cash windfalls to the audit partners to compensate them for helping grow and giving up the consulting business. Partners in the new consulting company get equity handouts. And again, ladies and gentlemen, if you're enjoying the content, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, to contribute to channel growth or to schedule an appointment with a licensed financial professional, the links are in the description of this video. Also, to create a comprehensive financial plan for yourself or to buy life insurance quickly, easily, up to $1 million with an instant decision, the links are in the description of this video. So, as we proceed to give you what you need. In the U.S., those staying with the mostly audit business were in line for a cash windfall worth 3 times their annual compensation, a higher multiple than for partners at some other EY firms. The people familiar with the matter said U.S. partners going to the new consulting company were set to get shares in it worth 9 times their annual compensation, paid out over a 5-year period, and accompanied by a significant cut in their cash pay, the people said. With just a small remnant of the firm's tax business, some U.S. audit partners were concerned that their business wouldn't generate the revenue that they'd hoped. No agreement has been reached on any alternative deal, including any that excludes the Americans, the people said. Still, the fact senior executives are prepared to contemplate pushing ahead without the U.S., which accounts for some 40% of global revenue, shows the deep rifts that have opened up within the firm. Damn, I didn't know that EY U.S. accounted for 40% of Ernst & Young's revenue. That means that Ernst & Young is humongous in the United States. Think about it. If they get global revenue, and most of their revenue, 40%, comes from the U.S., that's because of all that tax prep stuff, the tax fees. Like they said, Google paid $1 million in tax fees. So, Julie Boland, head of the U.S. firm, upset some other senior EY leaders when she, this month, told her 4,000 partners of a pause in the deal, according to people familiar with the matter. Even pretty senior partners are holding up their hands in horror and going, "What the hell is going on here?" One UK partner said, "They've really messed this up." Many partners at the U.S. firm are angry their leadership is endangering a deal that could land them big payouts. It's a small group ruining the fight, and they're about to get hammered by a lot of angry partners, one U.S. partner said. The deal has already cost EY more than $100 million, including staff time, the people said. The firm had largely completed the knotty process of deciding which firm each of its 13,000 partners would work for after the split. Only 50 to 100 partners had still to be assigned to one firm or the other, including fewer than 10 of the 1,000 or so partners in the U.S. tax practice, according to an internal webcast earlier this year viewed by the Wall Street Journal. Carmen DeCibio, the EY global leader and designated head of the consulting company, as recently as last month, told the journal's CFO Network Summit that there were no tremendous hurdles to getting the deal done, short of a deep economic downturn. But the deal's momentum stalled at a 3-day meeting in New York that exposed sharp disagreements on the executive committee of the U.S. firm, according to people familiar with the matter. A minority of the committee representing the auditors refused to sign off on the proposed agreement, the people said. The marathon talks broke up without reaching a consensus. Ms. Boland, the U.S. head and nominated leader of the new audit-focused business, refused to override the dissenting partners. The people familiar with the matter said, instead, she agreed to insist on a review of the plan, the people said, ultimately throwing the firm into its current state of turmoil. It isn't clear if any new agreement on a deal will quell dissent within the firm. A group of retired U.S. partners continues to raise concerns about Everest, particularly its impact on EY's audit business. A statement by 4 former EY leaders this week took direct aim at Mr. DeCibio. There are significant issues with the proposed transaction that go well beyond poor market conditions. The original design was developed by future consulting business leadership and had basic flaws. The statement said, according to a copy of a memo Tuesday to some retired partners viewed by the Journal. Mark Moore contributed to this article. So, ladies and gentlemen, what is the whole deal with Ernst & Young not reaching a deal? What's going on, Seeking My Creator, and what's going on, Miss Queen? So, what's the deal here? Ernst & Young can't reach their deal on their split up. So, the breakup is breaking up. So, what this means, Ernst & Young is in 75 countries across the globe. Ernst & Young is one of the largest financial services firms in the world in terms of taxes, accounting, and auditing. Okay, so you got Ernst & Young, KPMG. Geez, I can't even think of what they all are. Hold on, let me just Google. Big Four accounting firms. Ernst & Young, KPMG. I'm trying to think, who are they? Ernst & Young, PricewaterhouseCoopers, and Deloitte. Yes, so Ernst & Young, KPMG, PwC, and Deloitte. So those are the 4 largest, basically tax services firms in the world. And they run around the world and they audit and do taxes and all this other stuff and, financial strength, et cetera, et cetera. But as far as Ernst & Young is concerned, they operate independently in each country. So now they're trying to have an M&A or a merger and acquisition where they separate parts of the business, and those parts of the business and with which they're trying to separate can't all come to an agreement, already costing Ernst & Young $100 million. Now, why does this matter to the everyday person? Well, because mergers and acquisitions, and like I said, the situation with the coworker of my mother-in-law. She left Morgan Stanley because she didn't like the work conditions. She left Morgan Stanley because she didn't like the salary. She went to go work for E-Trade. Next thing you know, a couple of years later, merger and acquisition. E-Trade gets purchased by Morgan Stanley. That's why, as of today, you go and you see E-Trade powered by Morgan Stanley. You guys probably also don't know that Charles Schwab back in 2019 purchased TD Ameritrade. So TD Ameritrade is no longer a subsidiary of TD Bank. They are a subsidiary of Charles Schwab. You guys will not know this until later on this year, probably around October, will they begin switching all of your account numbers from TD Ameritrade to Charles Schwab, or however they're going to do it. I'm not exactly sure how they're going to do that. But things like this are what have an effect on even things like your investments when you go into the stock market. Now, again, none of this is investment advice, obviously, but it's the reality of what happens because these can be publicly traded companies when they make their separations, and their separation is similar to a thing like a stock split. This is why things like listening to your best friend tell you, hey, listen, I invest in Harlem World QQQ. Well, I think you should too. I'm up $10 bazillion. Because that's how people who invest talk. Because people who really invest are never up $10 bazillion. And they watch the market, but they have a time horizon. People who play the stock market are gambling. So they don't have a time horizon saying, I'm going to put money in X point, and then I'm going to get out at X point. This is why you'll have a lot of people who generally will sit there and be like, oh, the market is crashing, I'm sweating. Even people who are good in the market, because they don't have a time horizon, right? Or they don't have the risk tolerance, or the crash in the market has demolished their risk tolerance. So they're not able to withstand losing X amount more dollars, so they start selling in a panic. Or people who just watch the market for the sheer fact of watching the market, and then they just sell because, give me a second. I have a text message here. Wow. And then they just sell because they're emotional. Give me 1 second. There was another article that I wanted to share with you guys. I'm trying to find it here. Is this it? No, that's Fegley. I can close that. I can close that. I can close that. I can close that. Is this it? No, that's not it. Close that. Close that. Close that. Close that. Where the hell is the article that I wanted to share with you guys? I had a whole doggone article I wanted to share with y'all. Now I can't find it, and it's frustrating. But I have too many tabs open on my phone. All right, well, I'll share this one with you guys instead. How about that? Share. Send to your device. To my PC. Open a new tab. So, be real quick. I'm actually going to share this link with you guys because I'm not going to read the whole thing. Hopefully that'll go in there. Yeah, it did whatever it did. So let me share this link with you guys really quick. So this one, and actually I'm going to edit this stream. / how to use life insurance right now. Save changes. All right, whatever. X. All right. So now we're going to look at 4 ways to use your life insurance policy right now, from long-term care expenses to loans. And then for the rest of the week, I'll be starting up on this next book by a gentleman by the name of Mark J. Kwan. Hold on, let me see if I can do this solo real quick. Oh, wow, it just gets covered by the... Okay, so this book here, Top 25 Ways an IUL, Index Universal Life Insurance Policy, can secure your financial future and build tax-free family bank. So I'll be reading that for the next week as we continue with our book club selections, right? I think that's kind of cool for us to do. So let me get out of this solo mode and we will bring this back up. So 4 ways you can use your life insurance policy right now, from loans to long-term care expenses. March 31st, 2023 article. So most people think life insurance only comes into play after the policyholder passes away, but it's also possible to benefit from it while you're still alive, from loans to long-term care and more. Life insurance policies, particularly permanent life insurance policies, can help you beyond the death benefit. If you already have a term life insurance policy, it may be possible to convert it to a permanent life insurance policy. Check with your insurer to see what options are available to you. If you're shopping for a policy that can provide these possible perks, you may want to consider one of CNBC Select's top life insurance products picks for whole life insurance. They like Mass Mutual with a number of policies to choose from and a strong record of individual dividends. Pacific Life stands out for their universal life insurance with flexible, specialized products that can help you do things like supplement retirement income. So, what can you do with, hey, Just Ask Shar, how are you? And again, ladies and gentlemen, if you're enjoying the content, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, to contribute to channel growth or to schedule an appointment with a licensed financial professional, the links are in the description of this video. And again, greetings to Just Ask Shar. So, here we go. So, you can pay your premiums with the cash value. A permanent life insurance policy builds cash value as you pay your premiums, and that value in turn earns interest. This cash value is separate from the death benefit. and you can access this money while you're still alive. In fact, the cash value returns to the insurer after you die, so you want to use it before you lose it. Now, I need to pause here because this is very true. Cash value in a traditional whole life insurance policy does go back to the insurer after you die. For example, if you get a $100,000 whole life insurance policy and build up $50,000 of cash value and then get hit by a bus, the insurance company will take $50,000 of which you built up in your cash value, and they'll take $50,000 of their own money, and they give your beneficiaries $100,000. However, there are types of permanent life insurance policies and options on types of permanent life insurance policies where, let's use that same scenario. You buy a $100,000 death benefit, you build up cash value of $50,000, and then you pass away. The insurance company will take that $50,000 of your cash value that you built up, plus the $100,000 that they agreed upon in the contract, and give your beneficiaries $150,000. So there are truths, but there's some missing points. But they're very absolutely true when it comes to traditional whole life. The insurance company does keep your cash value, which is why a lot of people don't like traditional whole life, including myself. I prefer indexed universal life. We'll get to that later on. One way people spend this cash is by paying their premium. Since you'll likely be paying for life insurance premiums into retirement, this frees up more retirement income for your daily life and expenses. Given your retirement budget may be more limited than it was while you were earning an income, taking the expense of life insurance premiums off your plate could come as a welcome relief. I can close this article now. And let's open this one. You can use your cash value for a loan. So if you need a loan, your permanent life insurance policy's cash value can come in handy. When you borrow from your cash value, you borrow the money from your life insurance company with your policy as collateral. The loan generally does not require a credit check, and interest rates could be even more favorable than that of a personal loan. It sounds like an ideal way to get a loan, but it could lead you to losing your policy if you're not careful. For example, if the interest you owe grows larger than the cash value, the policy could lapse. And if you decide not to pay the loan balance, interest, and fees, or you die before you get the chance, it could reduce the amount your beneficiaries receive from the death benefit when you expire. While it's a way to get money in a pinch, you should have a plan in place to pay it back if you want to keep your policy in force. If you think a personal loan better fits your financial needs, CNBC does rank Lightstream as the online lending arm of SunTrust Bank as one of their best providers on the market, thanks to its low interest rates and flexible terms. So yes, ladies and gentlemen, these things do get sponsored by companies. What's going on, Oz Love to Talk? So, CNBC does get sponsored or paid for by these people to sponsor. Hey, go to them for this insurance. Go to them for that. So just be cognizant of that. So let's take a look at number 3. Bear with me. Excuse me. And remember, folks, hold on. Before I continue, I'm going to be reading this book. This is the next book that I'll be going over. Like I said, last book was Wealth Beyond Wall Street. This next book is going to be Mark J. Kwan's Top 25 Ways an IUL, Index Universal Life Insurance, can secure your financial future and provide a tax-free family bank. Okay? So just like Eyes Love to Talk said earlier on her live, I teach you this stuff because I'm telling you the truth, right? I'm not trying to BS you or anything, right? Like I said the other day, I got all these tattoos, right? I got all these tattoos, right? All these gang-related tattoos, right? Because when I was 18, I thought I knew what I wanted to be for the rest of my life. Who knew I would be in financial services, managing people's money? You think I want all these type of tattoos on me now at 38, 20 years after? Now, 20 years ago, when somebody asked me about life insurance, that's a lifelong decision. I got a lot of life to live. I ain't worried about that. I know what my life's going to be like anyway. Okay. I forgot I was 18, young, dumb, and legal, so I was able to mark my body up with all this nonsense that means nothing. But imagine if I spent those couple of dollars on life insurance. Hiru, what's going on? Right? So, let me stop belly aching and bantering and get back to the article. So, you can tap your life insurance for long-term care expenses. So, according to 2020 data from the Department of Health and Human Services, about 70% of 65-year-olds will need long-term care services, such as in-home care or assisted living facilities during their lifetime. Depending on the type of care and where you live, this can cost thousands of dollars a month. Adding a long-term care insurance rider to your life insurance could help cover these costs and prevent your family from paying out of pocket. While long-term care insurance is available as a separate policy, it's generally also available as an add-on to your life insurance policy. This rider can help you pay for care up to a certain amount each month and up to a certain limit determined by your policy. Now, here's why them talking about long-term care insurance is actually very important, and I'm glad they did that. Now, here's something that's very counterintuitive as a 100% commission-based salesperson. When I talk to people, I generally tell them not to buy long-term care insurance. I personally think long-term care insurance is very expensive, and the difficulty is it's a timing thing, because generally it's really expensive even when you're younger, but you generally don't need it until you're older. And when you're older and you will need it, it's ridiculously expensive, but it's cheaper than what it would cost you to go to the nursing facility. Or you end up having to, do the SSI thing and be completely destitute and sell your house and give up all your assets so that they'll hold you in, Sunnybrook Farms, Sunnybrook Acres nursing facility, where some, young girl who just got her CNA and a Nissan Altima, who a lot of these black men online complain about being CNAs, the same ones the black men complain about, though they're wiping ass, working in progress every day and seeing success. Not saying that black men don't have nothing to complain about, but these are those nurses' aides, and they don't really have your best interest in hand. They don't really want to wipe your ass, right? We'll be honest, right? So let me put my banner across here. So again, ladies and gentlemen, if you're enjoying the content, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, to contribute to channel growth or to schedule an appointment with a licensed financial professional, the links are in the description of this video. So again, they talk about long-term care insurance, and I kind of like the way they said it, because this is an unbiased opinion. And this is something that I tell to people when I'm having an appointment with them. Hey, look, you can buy long-term care insurance. It really depends. If it's something that is something that happens in your family, then get it. If it's something that's kind of up in the air, just get the rider onto your life insurance, right? I'm going to explain to you a few more ways, because they just explained a couple. So you can also cover care for a terminal illness. So if you're diagnosed with a terminal illness and your policy includes an accelerated death benefit rider, your life insurance could help you cover some of the medical costs. You also could receive a portion of your death benefit while you're still alive. So in order to use this rider, you'll need to be diagnosed with a qualifying terminal illness according to your policy. So generally there's three. There's terminal, critical, and chronic illness, right? So terminal means generally that you have the life expectancy of 12 months or less. So the doctor says, hey, Joe, you're going to die in the next year. Generally, companies will give you up to 75% of your death benefit. This is generally only on a whole life policy. You're not going to get this with a term life policy. Generally, with a chronic illness, meaning that you can't, a critical illness, meaning that you can't perform chronic illness, meaning you can't perform 2 activities of daily living. So you can't go to the bathroom on your own. You can't eat on your own. You can't bathe on your own. You can't get dressed on your own, things like that. They'll give you up to 50% of your death benefit. And this is tax-free. So let's say you got a $100,000 death benefit, and they say, Joe, you got cancer, you're going to die in 12 months. You call the insurance company, or you call me, Alonzo, Gold Cold doctor said Mr. Joe got cancer, he going to die in a year. All right, we'll give you $75,000 cash, tax-free. Go, jump off a cliff or do whatever you want to do with it. Chronic illness, you can't perform 2 activities of daily living. So your body is, you're in rehab, you had a car accident or something. This may be where you need the long-term care. That's why long-term care is very up in the air, because even though older people need long-term care, a lot of people need long-term care, because I think it's over 50% of people who actually need long-term care are under 45, because that's about the age when most people get into a serious car accident. I think it's between 38 and 46. So, it is what it is. So, but again, that's kind of that dynamic. So let's continue. Let's close that out. So again, they'll give you up to 50% on that chronic illness. And a critical illness would be like end-stage renal failure or blindness due to diabetes. They would give you up to 25% of your death benefit tax-free. Now, in order to use this rider, you'll need to be diagnosed with a qualifying terminal illness according to your policy. Using your benefits through an accelerated death benefit rider will likely reduce the amount of money your beneficiaries will receive when you die, but it could be helpful for you to make the most of your time and cover related expenses while you're still living. So, the bottom line, life insurance is mainly in place to help cover expenses and help your family when you die. But in certain situations, permanent life insurance policies could help you cover expenses, access cash, and care for yourself. So we're going to go in here and we're going to Google collateral assignment, because that's another way you can use your life insurance while you're alive. And I hate the fact that they don't talk about that here. So what is a collateral assignment of life insurance? So let's take a look here. This is from Policy Genius. So I'm going to do this article, and then I'm probably going to hop off because I want to go do some other stuff. I'm hungry, and I got some fried rice that I'm about to spice up. I always get their fried rice, and then I add my own veggies, and then usually like another protein. So we'll see. So what is collateral assignment of life insurance? Collateral assignment lets you use your life insurance as loan collateral. Wait a second, folks. Wait a second. Somebody, please, anybody, scream. And I talk about collateral assignment all the time. I want to make that as large as possible. That says collateral assignment lets you use your life insurance as loan collateral. So remember, ladies and gentlemen, all the time when I'm like, hey, you want to buy a house? Yeah, I'm going to buy a house. I'm going to buy a house. I'm going to go qualify for a mortgage. I'd be like, well, why don't you get life insurance? I don't need life insurance. I'm trying to go get this house. What do you need to go get a house? A mortgage. What is a mortgage? A loan? What can you use life insurance as? Collateral for a loan. Oh, oh. Mind blown. Should I continue with this article, folks? I'm going to continue with the article. So again, ladies and gentlemen, if you're enjoying the content, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share. Lastly, to contribute to channel growth or to schedule an appointment with a licensed financial professional, the links are in the description of this video. As well, to create your own financial plan without the assistance of a financial professional, the link is in the description of this video. To purchase life insurance up to $1 million with an instant decision and no assistance from a financial professional, the link is in the description of this video. So, when you apply for a loan, well, let's finish this. So collateral assignment lets you use your life insurance as loan collateral. When you die, your death benefit is paid to your lender first, and any remaining funds go to your beneficiaries. It's actually deeper than that, but you have to work with an agent who knows what the fuck they doing. Y'all know I like to throw my sentence enhancements in there, and I know because it irks people when they're like, you're supposed to be a professional when you're swearing. Well, I am professionally swearing because is it worse for me to say the word fuck or for us to live with the conditions we've lived with? I think the conditions are a little worse than the word fuck. So when you apply for a loan, particularly a small business loan or an SBA loan, you can use your life insurance coverage as collateral. You can also, again, use it as collateral against the mortgage. This is called collateral assignment, and it ensures that your lender will be paid any outstanding loan amount if you don't have a good credit rating or other collateral. Collateral assignment is different from naming the bank as the sole beneficiary of your policy, like with credit life insurance. Instead, collateral assignment ensures that if you die before repaying your loan, the insurance company will use your death benefit to settle up. After that, any remaining funds go to your named beneficiaries. If you already have a policy with a death benefit greater than your loan amount, you may also be able to collaterally assign that policy. However, some lenders may require you to buy a new policy specifically for collateral assignment. If you don't have a life insurance policy or you need additional coverage, you'll need to apply for a separate policy. Once you have a policy in place, you can request collateral assignment paperwork from your insurer. So, how collateral assignment works. Applying for life insurance for collateral assignment is the same as applying for a personal life insurance policy. You need to have an active personal policy before you can assign it as collateral. You'll go through the application review and the underwriting process and wait to receive your offer. Who to name as your beneficiary. When buying life insurance for the purpose of collateral assignment, you name the beneficiaries as you would for a personal policy. So, if your personal policy would list your spouse, you list your spouse. The lender is not your beneficiary. They are the assignee on the collateral assignment paperwork after your policy is active. On the form, you are the assignor. Now, as I go further into this, generally they're only going to want a whole life policy. And right now they're just talking about you dying. But the reason they're going to want you to have a whole life policy, and generally they're not going to want you to get the policy just for the purpose of the loan, right? They're going to want to see that you've had the policy for at least 2 years, that is cash value, and that has been enforced for at least 2 years with a purpose of other than getting the loan. And the reason why is because, number one, if you die, yeah, they can take that money if you die. But if you live and don't pay back the loan, because they are the assignee on the policy, they have the right to cancel the policy and take whatever cash value you've built to recoup some of their losses from the loan. It's kind of like them putting a lien on your mortgage or them garnering your wages from your paycheck at work. but you have to set it up for them to actually do such. So when you fill out a collateral assignment form, that assignment supersedes your beneficiary's right to the death benefit. If you die, the life insurance company pays the lender or assignee the loan balance. The remainder of your death benefit, if there is one, goes to your beneficiaries. For example, let's say you have a $500,000 death benefit and you have a $500,000 mortgage that you've assigned your life insurance policy to. And you live for a bunch of years and you paid your mortgage down to $250,000 and you die. Your death benefit will be reduced by $250,000 because the mortgage company is the assignee. So they have first right to that money. So their $250,000, bang. And then your beneficiary would get the additional or the remaining $250,000. But again, let's keep going because I broke it down a little further. Who owns the life insurance policy? So you are the policy owner and responsible for the premium payments. Some lenders may require an escrow account for the life insurance premiums. Others may require proof of payment or prepayment. If you use a whole life policy for a collateral assignment, the lender has access to the cash value of the policy if you default on the loan. So like I said earlier, that's why they're generally going to prefer that you use a whole life policy, not a term life policy, because if you default on the loan, they can just cancel the policy and get the cash value. Now, if it's a term policy, they might just send a hitman after you. But those are some of those things there. So, when to fill out the collateral assignment paperwork. After you pay your first premium, sign your policy papers and the insurer confirms that your policy is active. Then you can ask for a collateral assignment form from the life insurance company or your insurance broker. You'll need your loan officer's name and number for the form, as well as your policy number, social security number, and other personal information. When collateral assignment ends. Collateral assignment ends only if you pay off your loan before you pass away. Your lender must agree that the terms of your loan have been met and send a release to your insurer in order to terminate the agreement. If your policy lapses or you choose to cancel it, the lender could consider that a violation of your loan contract. They may even pay your premiums on your behalf to prevent a policy lapse. In that scenario, the lender adds the cost of any premiums they paid for your policy to your loan total. She says, no hitman, please. Hey, but listen, Shar, I get it, but the reality is life insurance has a big factor to do in loans, as you see. See, a lot of people are just worried about mortgage protection insurance or PMI, private mortgage insurance, or, a death benefit for when I die. But who thought about qualifying for a mortgage with your life insurance? Did you guys know that you could qualify for a mortgage with your life insurance? I'm literally showing you here that you can do it. But people, I'll think about life insurance later. This is why I said the wealthy put at least 7 life insurance policies on one life, and they start as soon as 15 days old. Because when you're young, it's stupid cheap, but it builds up cash better than any other product in existence. So, alternatives to collateral assignments. So if your lender doesn't require a collateral assignment agreement, but you want to leverage your life insurance for debt repayment, there are a few other options. So you can do a life insurance loan. A life insurance loan allows you to borrow directly from your permanent policy's cash value. You need to accumulate enough cash value to cover a loan, which can take a few years. Any unpaid amount plus interest is deducted from your death benefit. You can do a cash surrender, which means you can give up your permanent policy and take its cash surrender value, which is the amount of cash built up in the policy minus any administrative fees. This option involves canceling your policy, so you need to find replacement coverage, and you could face penalties if you cancel during your policy's surrender period. Term life insurance. You should always buy enough insurance to account for your debts. On average, term life is 5 to 15 times cheaper than whole life insurance, and your beneficiaries can use the death benefit to pay off your debts and keep the remainder, sidestepping collateral assignment paperwork or lender involvement. However, term insurance, in order for anybody to benefit, you have to die. For most people, the affordable and straightforward option is using your term life insurance death benefit to account for any outstanding loans when you die, with or without a collateral assignment attached. If you need to use your life insurance policy for collateral assignment, the process is as simple as buying a policy and filling out the appropriate paperwork. So that's pretty much it for me, ladies and gentlemen. Again, if you enjoyed the content, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, to contribute to channel growth or to schedule an appointment with a licensed financial professional, the links are in the description of this video. With that being said, ladies and gentlemen, wipe ass. Work in progress every day and see success. Wipe ass. Work in progress every day and see success. Wipe ass. Work in progress every day and see success. And remember, ladies and gentlemen, when people challenge you, they don't challenge you to challenge you, but they challenge you to challenge you. Accept the challenge. Salute. Oh, got ads playing. All right, well. Oh, yeah, no doubt, y'all. Definitely. Setting the record straight. What up, Brody? Maybe you'll catch the replay, but y'all definitely want to get with this because this right here, like I said, man, those two articles, let me see if I could put it back in here. So again, they're both in the chat, and in the description is a way for you to fill out a financial basically a retirement plan free of charge. It'll give you all kinds of graphs and charts. Some I invested in to make life a lot easier. I'm sending it to all my existing clients. And they give you that kind of bells and whistles that everybody likes. You know. Didn't want me, now I'm hot, they all on me. Back then they didn't want me, now I'm hot, they all on me. Back then they didn't want me, now I'm hot, they all on me. Back then they didn't want me, now I'm hot, they all on me. 212-470-9932. Call that number real soon. I'm trying to hook you, but you, yeah, what, yeah, what, yeah, what, 212-470-99 and 320. Well, yeah, I gotta find something wrong with that, right? Back then they didn't want me. What I said, hold up. 212-470, hit that number on the low, 9932. That's my cell phone. Call me and get your financial plan. I'm not a rapper. Back then they didn't want me. Now I'm hot, they all on me. Back then they didn't want me. Now I'm hot, they all on me. Back then, okay, I said, hey, purists, for sure this, I done sniffed and sold the purists, but now I'm on the block selling insurance, and it's something that I would suggest you get, cause you out here saying that you flipping it, saying you on the block out here getting it, saying you got the cubics are going in, flipping it, on the block pitching it, I'm saying you whipping it, and you say they're interested. Well, if that is really true, and you got people who significant, then you should really be considering Generational wealth. Life insurance is something you get. It's not just for your health, but it's for your status. I work in banking myself. I moved to get my series license. I certainly have my NMLS cert for lending. Oh, you've got your NMLS, like Pablo. That's actually awesome. I'll tell you what, I'm going to put my email address. Because literally what I was just talking about in terms of collateral assignment, if you're a mortgage loan originator, then this is something that you can actually start to get and, add an extra point to every client that you point this out to. But if they have a life insurance policy that's been in force for at least 2 years, you can start considering that as their asset, as their net worth. So you can actually use that as something to collateralize the loan against, right? It's similar to, what am I trying to think of? So not just using, as opposed to taking what, 10K out of their 401k or their IRA, they don't have to take anything out of their life insurance, though they could. But it's also available because they're able to show the liquidity of their down payment. So what securities license were you considering getting? Your Series 3, your Series 4, your Series 6? What's going on, okay? I'm getting ready to actually shut down because I'm about to go get me some fried rice. But what securities license were you considering, Pablo? Because that will depend on which one what you're going for and everything. Now, I don't want to see this. What else is it? That's my joint too. So yeah, you'll want to look at that in terms of collateral assignment. But what securities license were you looking to get, and what state do you originate in, Pablo? Because that's actually something very interesting. I was going to get my NMLS as well, but I decided against it. Right now, I have my PTIN, my Prepared Tax Identification. Used to have my realtor's license in New York State. Life, Health, Accidental, Property and Casualty, Series 6, 65, 63, SIE, going for the 7, going for my CRC. So yeah, I got a lot of certifications, bro. But I appreciate you for enjoying the stream as I try to rebirth my hip-hop career that never took off. So ladies and gentlemen, with that being said, wipe ass, work in progress, every day and see success. Wipe ass, work in progress, every day and see success. Wipe ass, work in progress, every day and see success. And remember, ladies and gentlemen, when people challenge you, they don't challenge you to challenge you, but they challenge you to challenge you. Accept the challenge. Salute. Fade to black. ADH Wealth Solutions. These things, play me at night, they won't act right. Understandable, smooth shit, the murderers move with the thieves things. Play me at night, they won't act right. Understandable, smooth shit, the murderers move with the thieves things. Play me at night, they won't act right. Understandable, smooth shit, the murderers move with meticulous movement. Coming out of my medulla oblongata. I ain't gotta show you how I grow my bravada, wearing all the Prada. I got a lot of fully funded 401k and IRA that I sell to myself like, yeah, yo, the product that I used to push on the block, moving like doo-doo, re-upping for a $980 block of fish scale, moving well, my homeboys moving through hell. Meanwhile, these cats getting it, These blacks getting ornery. Mexican cartels doing money laundering. Put $80 million in life insurance while I can't talk to a brother about it because he want to turn his left eye. That's right. We still gonna learn this until you die. White ass. Salute.